Thanks for clicking! All eyes were on Stats Canada this morning as it was set to release Canada's inflation data for the month of March, with the majority of economists thinking that inflation was going to come in at 3.1%. We got our answer at 8:30 this morning when inflation surprised downward, coming in at 2.9%, the second month in a row that inflation's come in below 3. Indeed, the surprising move downward on inflation will no doubt put more pressure on the Bank of Canada to cut rates at its June policy announcement. Yet the news comes as potentially re-accelerating inflation coming out of the United States is derailing hopes that the Federal Reserve will be able to cut rates this year, even as rate cuts coming from the Bank of Canada look more and more likely. In fact, though this is still early, there's a growing chorus of voices saying that the Federal Reserve may actually have to hike rates this year if inflation doesn't start to show some downward progress.
No way, never happened.
But with it looking more and more likely that the Bank of Canada will be cutting rates ahead of that of the Federal Reserve, Scota Bank's Derek Holt is warning that if the bank cuts too far, the value of the Canadian dollar could crater. But is this the case? Lucky for us, we have one big glaring example coming out of the mid-1990s when the Bank of Canada cut rates far below that of the Federal Reserve, and even the central bank had to explain the policy divergence. So what I want to do today is go over Canada's inflation data for the month of March, take a look at what happened the last time the Bank of Canada's policy diverged too much from that of the Fed, and then discuss some implications. As we'll see today, fiscal policy can and does have a big impact on the value of a currency, and we're expecting to get the release of Canada's 2024 budget out later on today. We'll obviously have any major updates on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this inflation report. Onto the inflation data. As mentioned, Canada's headline inflation came in at 2.9% in March, the second month in a row that we've come in below 3%. Major upward contributors to the inflation rate continue to be mortgage interest costs, followed by rent, food, gas, and auto insurance. On the other hand, telephone services, internet services, natural gas, men's clothing, and homeowners' replacement costs, meaning house prices, put downward pressure on the CPI.
Ignore that!
But the big story is the downward trajectory in measures of core inflation, the measures which the Bank of Canada looks to when deciding whether or not to lower or raise interest rates. CPI median and CPI trim both fell to 2.8 and 3.1% respectively. These are the measures the Bank of Canada looks to when deciding whether or not to lower rates, and will no doubt be a guidepost to the bank when it makes its policy rate decision in June.
I was lying, sorry.
And this is all good news for those hoping for lower rates come the June announcement. Headline inflation is down despite rising gas prices, and core inflation is at its lowest point that it's been since August of 2021. Bond yields fell on the news as this increases the chances the Bank of Canada is going to be cutting rates, though yields still remained well above where they were before the hot US inflation data came out this month. As we've talked about before on this channel, the hotter than expected inflation data coming out of the United States is a real problem for Canada. With the US Federal Reserve set to keep rates higher for longer and all signs pointing to the Bank of Canada might be cutting sooner rather than later, there is a real risk out there that the value of the dollar could plummet. As we've talked about before on this channel, with the United States paying more to service its debt, there will be a greater demand for its dollar, as dollars are needed to loan them to the United States. And we can see this in just the past month alone, with the value of our dollar plunging relative to that of the United States, as it becomes more and more likely that the interest rate policies of both countries are going to diverge.
Now I gotta turn my back.
But lucky for us, or not, we have one big glaring example available of what happens when the Bank of Canada's policy rate diverges too much from that of the Fed. As, back in March of 1996, the Bank of Canada started to cut rates while the Federal Reserve held firm, eventually reaching a policy rate divergence of 225 basis points by 1997. The move at the time was largely unprecedented, as we can see from the graph and as articulated by the Bank of Canada at the time. The last time Canada's policy rate diverged that much for that long from the United States was in the 1970s. At the time, Canada's central bank noted that despite the policy divergence, there were a number of factors going for Canada which should prop up its dollar. And they were right. Between March of 1996 and July of 1997, though the value of our dollar ebbed and flowed, its value remained relatively stable. And as to why, the bank noted at the time of its divergence that Canada had four main advantages going for it that would prevent that downward spiral. 1. Lower inflation in Canada than that of the US. 2. Improving fiscal positions of the Canadian government. 3. Strong competitiveness of the business sector. And 4. Firm commodity prices. So, because Canada's inflation was lower, our fiscal position was better, our business was more competitive, and high commodity prices, the Canadian dollar would be prevented from a big plunge. And, as we saw, they were right. In May of 1997, the Canadian dollar was actually trading higher than it was in March of 1996. The bank noted in its 1997 monetary policy report that improving fiscal positions of governments in expectations of continued low inflation underpinned the value of the Canadian dollar. Further, the bank also noted that the strong competitive nature of Canadian industry helped to fuel external demand, helped to fuel demand for Canadian goods, hence demand for Canadian dollars. So, there we have it. The last time the Bank of Canada lowered rates relative to that of the United States was back in 1996 and 1997, back when Canada had a fiscal surplus. And the value of the dollar was protected by that strong fiscal position, as well as the competitive nature of the Canadian economy.
Say goodnight, Ramo.
Well, yeah, to a certain extent, that's the case. Out of those 4 advantages that the bank outlined in 1996, only 2 of them are still present today. Canada's inflation rate is in fact lower than that of the United States, and if oil prices continue to move higher, that should help strengthen the dollar as well. But the fiscal position is a whole different story, with deficits continuing to grow, projected to reach $38 billion by 2025. Further, we've seen report after report lamenting the decline of Canadian competitiveness, not to mention the central bank sounding the alarm over Canadian productivity. As such, Scota Bank's Derek Holt could very well be correct that if the Bank of Canada diverges too much from the Fed, we could see a major devaluation of the Canadian dollar. Economists from National Bank appear to concur, noting that the dollar's lackluster performance, even with upward pressure on oil prices this year, was a notable curiosity, meaning that, with oil prices rising, one of the things the Bank of Canada had going for it in the 1990s, and our dollar is still sinking. We should have seen some upward support for the value of the dollar on higher oil prices, and we didn't.
Why?
And this is a problem, as we've talked about so many times before on this channel, and according to Benjamin Reitz of the Bank of Montreal, if the dollar falls too much, the currency differential could effectively import inflation. Meaning, if the value of our currency falls too much, everything we import is going to cost more, and that's going to show up in the CPI data. As such, some, like Royce Mendez of Desjardins, says that the Bank of Canada can only cut rates once or twice before the spread between Canada and the Fed moves to uncomfortable levels. Now, obviously, none of this is a science. We don't know exactly how investors are going to react to a major spread between the policy rate of the Bank of Canada and the federal funds rate coming out of the United States. But if 1996 and 1997 are any guideposts, 2 of the 4 conditions which help to prop up the currency, a strong fiscal position and competitive business, are no longer exactly present. And make no mistake, the Bank of Canada is very, very aware of the risk of importing inflation if it cuts rates too much. Bank of Canada Governor Carolyn Rogers discussed it last year.
It is true, if our dollar depreciates, particularly against the currencies of our key trading partners, that means imports coming into the country are more expensive. That can put upward pressure on inflation. If that happens, that'll have to get built into our forecast.
And both her and Governor Macklem were alive in the 1990s. As such, if we do get that June rate cut, which is apparently becoming more and more likely, I wouldn't expect continued and sustained multiple moves downward thereafter, though the governor will no doubt be asked about it ad nauseum. So, inflation coming in cooler than expected, headline inflation down below 3%, core inflation down below 3%, all good news, all pointing to a probable rate cut coming from the Bank of Canada in June. With that said, risks remain, and one rate cut does not mean we're going to get 7 or 8 soon thereafter, but we will continue to track Bank of Canada policy on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.